immediately prior to the occurrence. So it will be materials of a similar quality as existed at the time, but certainly not superior. There's no betterment involved. Or it's the insured value, whichever is the less. So betterment is excluded. If it can be done more cheaply, the policy will respond for the cheaper option. If the client wanted to put in a replacement that had additional whistles and bells and better quality, the underwriters would accept that, but they will say we would only pay the reasonable cost. The balance is down to you as the insured. And that type of thing happens very often, and that's up to the broker and the loss adjuster to negotiate with both the client and the underwriters to come up with a fair and sensible settlement. If it's not of like kind, it is basically underwriters will pay the lesser of the actual cost to replace, or if it's an alternative system, if it's an older structure, for example, and it may well be that it's not worth replacing the structure, but they may put in some subsea modules, some subsea wellheads, the policy would pay for that as long as the cost of that is less than the insured value of the item that was lost. If it was more than that, they'd pay up to that value. Constructive total loss is a concern we mentioned earlier on when the question was raised. Constructive total loss can become an issue because you can have the asset insured for different amounts, and so underwriters need to take into account the insured value, whether following loss, is it going to be recovered, is it going to be repaired. You can have within the policy form co-insurance clauses. If the underwriters believe that the client has underinsured something, they may say, okay, we accept that valuation, but we want to have a co-insurance clause in there which maybe say 80%. So what that means is that the client, the insured, will pay, if it's an 80% co-insurance clause, the insured will pay 20% of any loss. Warranties in the policy, very common policy requirement is that there's got to be a blowout preventer fitted. If the insured is the operator, it's an absolute warranty, and it's incumbent on them to make sure that there is a blowout preventer fitted. If they are not, they have to have, the requirement is that they as the operator, they as a partner, have to use best endeavours to encourage the operator to, but the underwriters accept that as a partner, the client, the insured may not be in a position to determine that. Due diligence, the underwriters expect operations to be carried out up to internationally recognised standards. It is a risky business. There are hydrocarbons present, so there is an obligation that the client carries out their work in a fit and proper manner. We saw in Cliff's presentation this morning that unfortunately sometimes that doesn't happen, and when that doesn't happen, there is usually a catastrophic result. Minor works is effectively small construction policies, and by small that can sometimes for certain clients be quite a large sum of money, but it will be sub-limited. Usually excludes subsea works, but it can be included if it's specifically agreed. But it basically will give cover for the operator or for the partners for minor works, construction work that might be going on during the project life, during the operational lifetime. Works will be done, maybe 10 million, maybe 20 million, maybe up to 50 million, but rather than go out and place a separate construction policy, there will be provision to cover minor, and the minor is up to negotiation, construction activity within the operating policy. And the broker has to look at that. If there's considerable construction activity, it may be necessary that you need to include within the policy a specific construction form, because there are certain perils associated with the construction activity that need to be addressed in a construction form, not in an operating form. Temporary removal, sometimes things need to be taken away for maintenance, even if it's not from physical loss or damage. They may need to be upgrades. Usually the intention is to cover the asset where it is. If something needs to be removed for upgrades, for maintenance work, while it's away from the named location, it will be covered for its temporary removal. Acquisitions, oil companies buy and sell assets all the time, and it's common to include acquisitions, and there usually will be a requirement that that has to be reported to underwriters within a specific period of time. So what are the main exclusions? Started off by saying it is an all risks form, so that does mean that there are a considerable number of exclusions, and we'll work through most of those. But again, being an all risks form, the client submits his loss, underwriters have to prove one of the excluded perils, excluded risks. So if the loss occurred prior to inception, other than for latent defect, that wouldn't be covered. Following the heavy storms in the Gulf of Mexico, Rita and Katrina in 2005 and 6, named windstorms within the Gulf of Mexico are now excluded, but coverage for that can be bought back. So that's an additional buyback. So the underwriters wanted to be able to manage their Gulf of Mexico exposure much better. They wanted to get a premium for that, which they weren't getting before. So the standard position is to exclude the Gulf of Mexico, not because they won't cover it, but then that means that the client has to come back with specific information to include that as a buyback. And the underwriters can then see how much premium they're getting for Gulf of Mexico in relation to the claims they're having to pay out. Oddly, earthquake is a standard exclusion, and it was there from the very beginning, and I'm never really quite sure why it was, but it's just one of those things. When the form was originally drafted, earthquake was an exclusion, and it's nearly always deleted. The brokers delete it, the underwriters accepted it. The form has been revised God knows how many times over the years, but it's never been a standard deletion. It's just one of those quirks. Perhaps it'd be a sad day if it became too predictable, but it starts off as an exclusion and the brokers delete that. And I've got no idea. It must have been an accumulation when the form was originally drafted, that there was a concern that there were assets in a part of the world where earthquake was a risk, and that potentially it would have destroyed the energy market in the early days, but certainly today there isn't. Yeah. Yeah. Because Chris Rome was one of the drafters of the platform form, wasn't it? It goes back to... Yeah. It wasn't that long ago. Relief wells are covered under the controller well form, so that's where that would be covered. It can be covered under the property form if notice is given to underwriters. You may be wondering why blowout is a specific exclusion when it's covered under the controller well that Jeff talked about. One of the reasons that is in there, if the insured didn't buy controller well insurance and their assets were at risk, there is an argument that they could say that the costs associated with controlling that are sewer and labour expenses. So there would be an argument that what should really be controller well type costs could be submitted as sewer and labour costs if you didn't have a controller well policy, and the intention is that the controller well and the costs associated with that are covered by a controller well form. If the client doesn't wish to buy that, that's their choice, but the underwriters don't want to include control of well related costs within the property form. So it's not that coverage isn't available for that, but it fits more correctly in the controller well policy. All of that exclusion is an odd quirk of the wording that was drafted in the drafting took place in the late 60s, and that exclusion started off in there but is always deleted. So effectively you can ignore those because it's taken out of the deletion is then deleted, so effectively the coverage is bought. It's not done as a buyback. You don't pay for it, it's just you delete that exclusion.
There's a number of these forms where it's just common to see in the conditions, number of deletions, lines and deletions, and it's people, probably the new young guys, probably don't even know what those actual deletions are. Because it's so standard, you see it all the time. And Rob's right, why they haven't amended the form, I don't know. It just makes no sense.
Make sure we keep reading it, I guess. Delay is an exclusion because you can buy the coverage for that with business interruption, loss of hire policies. So we're talking about physical loss or damage, not the consequences of that. This exclusion is a good example of an all risks form and brokers doing their best on behalf of their client over years to come up with justification for claims being covered where an underwriter may say that's not the intention. I think we all are aware of wear and tear. It's a standard exclusion on all policies, and I think most people in the room we all understand what we mean by wear and tear. The devil is often in the detail, and it's not until you start analysing the wording that you see these additional deletions that have come in over time. Scouring if you've got pipelines sitting on the seabed where it's particularly tidal and it's on a sandy surface, as the tides wash over, you've got scouring away, and that can damage the pipeline. Now, is that wear and tear or is that scouring? At some stage, there would have been a claim put forward on the basis that scouring is not wear and tear. That would have been successful. So at the next joint rig committee, they'd have said, I'll tell you what, we're going to put scouring in as an exclusion because some clever broker has just got a claim paid. We believe it was wear and tear. They argued that it's scouring. We'll clarify that in future by having both as an exclusion. And that goes right the way through. Abrasive action of the sea, metal fatigue, expansion or contraction, rusting, oxidisation. Many of those are standard exclusions, but you see specific words that have come in, and they will have come in because of the results of claims negotiation on a particular loss.
Quite often machinery breakdown is taken.
Yeah. Often machinery breakdown will be deleted from the exclusions.
I'm just thinking of a flow line or pipeline or things that I can see, and maybe oxidation happens.
Mm-hmm.
Something is damaged, leakage occurs over time, don't you notice it? And a claim is lodged. Just being able to determine that what was caused by oxidation. I don't know whether you have an experience where a loss occurs in the sea, on the flow line, or a pipeline, and you cannot really be able to detect whether it's oxidation, wear and tear, or what has caused all these things. If I will be able to explain such a thing, because most of these things being in the sea, there's a possibility of oxidation happening.
It's a very good question, and it's an area where there's been lots of claims activity, lots of negotiation, and what will happen is the intention of the policy is to cover physical loss or damage from a known event. That's like with all policies, fire, explosion. So the intention is to not cover something that repeatedly happens over a period of time. And that's where the wear and tear bit comes in. But the oxidisation and things like that are the chemical reactions that are going on. There are often lengthy and costly claims negotiations where there will be non-destructive testing that takes place, where there'll be some very highly qualified experts that will be employed perhaps on both sides. The underwriters will employ a firm of experts, the client will employ either have their own engineers or getting a third party. And the idea will be to look at the damaged piece of pipe or whatever it might be and say, was that caused by one event? If it was caused by one event and you can demonstrate that it was proven by one event, the policy will respond. If it was something that happened over a period of time, then it's not the intention for the policy to be paying for that. But there have been many occasions where arguments have been put forward by the client and the broker, which has meant the underwriters have had to pay claims. Accelerated corrosion is one. Corrosion is excluded. what brokers and the client have been able to demonstrate at times is that if coatings haven't been applied correctly and a pipe's been installed and the coating has a life expectancy of 25 years, if after 5 years the coating has been worn away, it has been corroded, underwriters would say, oh, it's corroded, and that's an exclusion. The broking argument, the client's argument is, or would have been, it was accelerated corrosion, and claims would have been paid on that basis, and now accelerated corrosion is an exclusion. Just on the, so where you have, if fire or explosion occurs because of any one of these, then the resultant physical loss or damage is covered under the policy. Faulty part is excluded, but there's buybacks available. Electrical derangement, which goes back to the onshore forms, that is an exclusion that sometimes is deleted, but it sits in the policy, but the resultant damage is covered. Again, one of the tests is if you've had a major loss, how, and there's very little evidence left, how you prove the extent of the electrical derangement and the cost of that derangement is very much open to negotiation and debate. Other exclusions that are in the policy, these are ones that certainly the first few there are sort of general exclusions you'd see in many policies. They're not necessarily specific to the offshore world. Strikes rights, civil commotions, sort of political risks, there is separate coverage that is available. Unexplained loss, mysterious disappearance, so if the client does an inventory stock take and finds that there's some equipment missing but doesn't know when or how, the policy wouldn't respond for that. Clearly, fraud is not covered under a policy, as you'd expect. Fines and liquidated damages, if you've done something wrong, it's against the public interest for the client. There's a moral hazard there if the policy responded to the insured doing something wrong that resulted in a fine. Liabilities to third party, the next presentation is liabilities, and so that's where the coverage would rest for liabilities other than for removal of wreck. There have been occasions where property, pipelines, flow lines have been put in the wrong position for a variety of reasons. The policy doesn't respond for repositioning of that. That's a business risk, that's an error on behalf of the project, unless there's been physical loss or damage. Temporary or permanent blockage of a pipeline, an example there, in Angola, for example, the oil is very, very deep, it's very thick, and it needs to be heated to flow properly. If it wasn't heated and blocked the pipeline, there isn't necessarily physical loss or damage, it's just blocked up. There wouldn't be coverage for that unless it was possible to prove that the blockage was caused by physical loss or damage. So it's very much coming back to physical loss or damage. Scraping of pipelines, coating, that's going to happen over time. The market would view that, or the underwriters would view that as effectively as consumables. Unless there's been, again, a physical loss or damage, it's expected that pipelines will suffer from scraping and painting issues over time. So that wouldn't be recoverable. We're nearly there. I did promise there was lots of exclusions, but not too many to go. War and civil war, offshore, you can buy a separate policy for that, but it's not covered under the standard form. We talked about that yesterday. Piracy, again, for many years wasn't an issue, then it became an issue off of the situation in Nigeria, Somalia, and we've seen in Indonesia examples. Derelict weapons of war was an issue in the North Sea for a long time. After the Second World War, there were lots of bombs that hadn't exploded that fishing boats and structures have mysteriously disappeared or been damaged when there's been explosions late at night that no one's really known what they were, and it's usually derelict weapons of war. That's not covered under the policy. Political risk coverage, capture, seizure, detainment, restraint. So if a government impounds something, that's not covered under the policy. There's a separate market for terrorism. Many years ago, terrorism was usually thrown into the policy and wasn't charged for. After 9/11, terrorism became a product in its own right. Many underwriters and brokers have made a lot of money out of the terrorism market, huge rates for a long time, and we've seen that tailing off a lot now, to the point where terrorism it used to be placed as a facultative product in the way that control a well is, or the property form. Terrorism has become such a standardised product now that most brokers have got facilities, and it's just declared to the facility. The next thing is we'll see terrorism. You'll be able to buy terrorism insurance on the internet, I should think. The standard industry clauses, cyber. We could spend a whole presentation talking about cyber, and one of the engineers that works for Cliff has done a lot of cyber work in his previous life and has lectured in America on the risks facing the oil companies. There are standard cyber exclusions. These you would look at as being treaty exclusions. They're imposed by the reinsurance market. And cyber is an area where I think we will start to see some change and movement in the short term. Cyber is a product that the oil companies want to buy. The insurance market at the moment can't provide the coverage, but it will get there. Radioactive exclusion, again, is a standard treaty exclusion. Those will remain, but the cyber will become a product that can be purchased. At the moment, the market doesn't quite know how to manage its accumulation, but cyber is a product that's very much needed by the industry. The property, so we've talked about the exclusions within the policy. The property that's excluded, drilling rigs themselves are covered would normally be covered under the drilling contractor's own programme. Onshore property is not covered unless it's scheduled. So if it's declared in the schedule, then you're okay. Wells are covered under the Control of Well programme that we talked about this morning. Drilling mud, cement, chemicals is seen as a consumable. It's going to be used up, so that's not going to be covered under the policy. Casing and tubing is not included. Unrefined oil and gas, unless you've got a oil in store section under the policy. Blueprints and specifications are not covered, but you wouldn't expect them to be, and they're not really at risk because it's unlikely that drawings and plans will be on the offshore structure itself. They'll normally be back in the owner's offices or the project managers or the contractors, and there will be copies of them around. Just very quickly, finishing up before we get to lunch, there are a number of buybacks that are available with the standard form. We talked earlier on about the Gulf of Mexico named windstorm, which is probably of those, the US named windstorm and the wreckage or debris removal are the ones that are most commonly bought back. You can also buy coverage for floating production, storage units, floating production, storage and drilling units, which are more vessel related rather than structures, but there is provision to be able to buy cover for that. The offshore host platform, you may have the insured may have some assets that are pumped or pipelined or tie into another asset which they don't have an interest in, but if there was physical loss or damage to that host platform that needed to be that resulted in physical loss or damage, it might mean that there would have to be a shutdown at the subsea tie-ins at the client's smaller tied-in facility. So if there is, you can buy cover that effectively, if there's loss or damage to a third-party asset that affects your asset, you can buy insurance for that. So that's a quick review of an operating package. If anyone's got any further questions, or is everyone desperate to get to lunch?